Okay, maybe I'll share a little bit from the accounting perspective as well, because Asia is also trying to transition and implement the IFRS standards to make it more comparable and transparent. And with growth stagnating in a lot of Asian business groups, right? The tycoons and the entrepreneurs, they're thinking of inorganic growth opportunities through M&A acquisitions. And as we know from the accounting perspective, when there's M&A situation, the difference in the price paid and the asset that were acquired will create goodwill, what we call goodwill that's in the balance sheet. So in the IFRS, compared to the local GAAP for the respective countries like Korea or Taiwan or etc., local GAAP before IFRS implementation requires amortization of this goodwill and intangibles that arise from the M&A situation. So with the IFRS, say for instance in Korea, which was implemented mandatorily a couple of years back, the new IFRS requires impairment tests on an annual basis. So they will assess the so-called on a net present value of the cash flow, whether is there an impairment in the value of the assets that were acquired. But a lot of times in Asia, the auditors, even the Big Four, because they are reliant in terms of audit fees and non-audit fees in consulting to a few of these important business groups, right? Because it's like a very tight network of businesses that can give a lot of revenue to these firms. They acquiesce to the demands of the clients. So in terms of the impairment tests of all these goodwill and intangibles, there are usually no impairment at all until things got so bad, and then there's a sudden huge write-off, and by that time it arises, it's usually too late for minority investors to protect themselves from any sharp correction in the share price that arise from this sort of write-off in the impairment test. So that's one of the example of accounting problems in Asia. So another is, of course, we have discussed this quite a fair bit, is the tunneling opportunities presented through related party transactions, specifically in the other receivables account, whereby, say, for instance, a lot of times the fast-moving consumer goods company selling their products in the supermarkets, they need to place a lot of the products on the shelves of supermarkets. Product placement expenses is a key expense. But this expense in Asia is not inside the annual report or financial statement. It is outside of the listed vehicle to keep the accounts, looks nice for capital raising purposes, but the expenses are there at the group level and in the unlisted side. So for investors who just blindly look at the financial statements they're audited, I think without looking into understanding and appreciating the business group structure, the accounting dynamics, I think that will present a lot of problems for the sustainability of the returns.